Listen carefully because what I am about to explain is far more important than a simple move in gold or silver prices. Most investors are looking at charts, headlines, central bank statements, and daily market fluctuations, believing those things will tell them where the next major opportunity will come from. But that is not how major financial transitions reveal themselves. The biggest shifts begin underneath the surface long before the majority notices them, and by the time the crowd finally understands what is happening, the repricing is already well underway. If you own gold, if you own silver, or if you are considering whether hard assets deserve a place in your portfolio, you need to understand something. The environment that suppressed precious metals for years is beginning to show signs of strain. I am not talking about a temporary rally. I am not talking about a short-lived reaction to a news event. I am talking about conditions that often appear before much larger moves begin to unfold. History has proven this again and again. Markets do not wait for certainty. They move ahead of certainty. They anticipate change before economists agree, before analysts update their forecasts, and before policymakers publicly acknowledge the risks building inside the system. This is why so many people are caught off guard during major transitions. They wait for confirmation when markets are already responding. Right now, most investors remain focused on the same assumptions that guided them through the last decade. They believe monetary authorities can always stabilize conditions. They believe inflation pressures will eventually disappear. They believe debt can continue expanding without consequence. They believe liquidity will always be available when markets need support. But the real question is not whether those assumptions worked in the past. The real question is whether they still apply in the environment that is forming now. What concerns me is not a single economic indicator. It is a combination of factors developing simultaneously. Debt burdens continue to expand. Fiscal deficits remain elevated. Governments face increasing financial obligations. Economic growth is slowing in many areas while spending commitments continue rising. At the same time, inflation has proven far more persistent than many expected. You need to understand what happens when those forces begin interacting with one another. A heavily indebted system requires low borrowing costs to remain comfortable, but inflation makes low borrowing costs difficult to maintain. When policymakers attempt to control inflation, they create pressure elsewhere in the economy. When they attempt to support growth, they risk reigniting inflationary pressures. That creates a situation where every policy decision carries a trade-off. Markets recognize those trade-offs long before they become obvious to the public. This is one reason gold and silver deserve attention right now. Precious metals are not simply commodities, they are financial signals. They often reflect changes in confidence before those changes become visible in broader markets. When investors begin questioning long-term monetary stability, capital starts looking for alternatives. Not all at once, not dramatically, but gradually enough to create powerful trends once momentum begins building. Most people miss this process because they are watching prices instead of watching behavior. Behavior tells the real story. When investors repeatedly buy pullbacks instead of selling them, behavior changes. When institutional money begins increasing exposure after years of neglect, behavior changes. When assets that were ignored suddenly start attracting attention without widespread excitement, behavior changes. And when behavior changes, price eventually follows. This never ends quietly. Every major repricing cycle begins with skepticism. People dismiss early signals because they remember previous disappointments. They remember failed breakouts. They remember periods where nothing happened. They become conditioned to expect the future to look like the recent past. That conditioning becomes dangerous during turning points. The majority always expects tomorrow to resemble yesterday. Yet financial history is filled with periods where structural conditions shifted and forced investors to reevaluate everything they thought they understood. I believe we may be entering one of those periods. Look around the world. Nations are reassessing trade relationships. Supply chains are being reorganized. Strategic competition is increasing. Governments are spending heavily to secure critical resources and infrastructure. Monetary systems are facing growing pressure from rising obligations and slowing productivity growth. These are not isolated developments. They are interconnected, and when multiple pressures emerge simultaneously, markets begin searching for assets that exist outside the traditional promise-based financial structure. Gold has served that role for centuries. Silver often becomes even more interesting because it sits at the intersection of monetary demand and industrial demand. It benefits when investors seek protection, but it also benefits when technological and industrial requirements continue expanding. That combination creates a unique dynamic. When confidence weakens and industrial demand remains firm, silver can react much more aggressively than many investors expect. The reason is simple. Silver is a relatively small market compared with the enormous pools of capital that exist globally. It does not require a massive shift in investor behavior to create significant price movement. Even modest reallocations can have an outsized impact when positioning remains limited. Most people are completely blind to what is forming because they are waiting for an obvious crisis. But major transitions rarely announce themselves in advance. They emerge through subtle signals. They emerge through changing capital flows. They emerge through shifts in investor priorities. And they emerge when confidence slowly begins migrating from financial promises toward tangible assets. That is why I continue watching gold and silver so closely. Not because I am focused on a specific price target, not because I am predicting an immediate crisis, but because the underlying structure of the financial system is showing signs that deserve serious attention. And when structural pressure begins building beneath the surface, precious metals are often among the first assets to respond. You need to understand that one of the biggest mistakes investors make during periods like this is assuming that markets will provide a clear warning before conditions change. They rarely do. The signals appear gradually, often disguised as normal volatility, normal economic adjustments, or temporary market noise. Most participants dismiss them because they do not fit the prevailing narrative. That is exactly why opportunities emerge in the first place. Think about how major financial shifts have unfolded throughout history. They were never obvious at the beginning. During the early stages, experts debated whether anything meaningful was happening at all. Policymakers insisted conditions remain manageable. Investors remained focused on recent performance, yet beneath the surface, pressures continued building until the system reached a point where adjustment became unavoidable. That pattern matters today. The reason it matters is because many of the forces supporting asset prices over the last decade are becoming less reliable. For years, markets benefited from abundant liquidity, low borrowing costs, expanding debt, and confidence that central authorities could intervene whenever instability appeared. Those assumptions created an environment where risk assets flourished, but systems evolved, conditions changed, and eventually the factors that once provided support begin creating vulnerabilities instead. When debt levels become large enough, growth must work harder simply to maintain stability. When deficits expand year after year, financing requirements increase. When governments spend beyond sustainable levels, future obligations grow. None of these developments create immediate collapse. Real financial stress rarely appears that way. Instead, it accumulates. It builds gradually beneath the surface until confidence starts weakening. That is the part many investors fail to appreciate. Markets are ultimately built on confidence. Confidence in currencies, confidence in institutions, confidence in future earnings, confidence in debt repayment, confidence in financial stability. When confidence remains strong, valuation concerns often get ignored. When confidence begins eroding, everything changes. This is where gold and silver become important. They are not dependent upon quarterly earnings reports. They do not require a corporation to achieve growth targets. They do not depend on a government's promise to repay obligations decades into the future. Their role is different. They function as stores of value when uncertainty increases and when trust in the broader system begins facing challenges. History has shown this repeatedly. During periods of monetary stress, investors seek assets with limited supply and long-standing credibility. During periods of fiscal strain, investors seek protection against declining purchasing power. During periods of policy uncertainty, investors seek alternatives to financial assets whose valuations depend heavily on confidence. This is not speculation. This is how capital behaves when risk calculations change. What makes silver particularly interesting is that its investment story is only part of the equation. Unlike many assets, silver benefits from multiple demand channels simultaneously. Industrial demand continues expanding across sectors that governments and corporations consider strategically important. Advanced electronics require silver, energy infrastructure requires silver, data systems require silver, medical technologies require silver. Emerging technologies increasingly rely on silver because its physical characteristics remain difficult to replace. Those trends are not disappearing. If anything, they are becoming more significant. At the same time, investors are beginning to reconsider the role of tangible assets inside diversified portfolios. For years, many ignored precious metals entirely because other assets appeared more attractive. Strong equity markets reduced interest in defensive positioning, easy monetary conditions encouraged risk-taking, precious metals became an afterthought, but sentiment never remained static. Eventually, conditions change enough to force reassessment, and when that reassessment begins, markets often move faster than expected because positioning starts from such low levels. This is one reason I pay attention to capital flows rather than predictions. Predictions are everywhere. Some analysts forecast extraordinary upside, others forecast disappointment. Some focus on technical indicators, others focus on economic data, yet none of those forecasts matter as much as actual behavior. Where is money moving? What assets are attracting demand? Which sectors are gaining attention despite widespread skepticism? Those questions reveal far more than headlines ever will. Right now, evidence suggests investors are becoming increasingly interested in assets that offer protection against uncertainty. That should not surprise anyone. Look at the broader environment. Inflation remains a concern, government debt continues expanding, geopolitical risks remain elevated, global economic growth faces challenges, currency purchasing power remains under pressure over long time horizons. When investors evaluate those realities objectively, diversification into hard assets becomes easier to justify. The fascinating aspect of silver is that it often reacts more dramatically than gold during periods of increasing demand, not because it is superior, not because it replaces gold, but because its market structure is different. Silver's market is smaller, simply growth is slower, available inventories can become constrained, investor participation remains relatively limited compared with larger asset classes. Those characteristics create the potential for amplified price responses when demand increases. Most people focus exclusively on price charts. I focus on preparation. Preparation determines outcomes long before markets reveal their intentions. The individuals who recognize structural shifts early gain flexibility. They can make decisions thoughtfully rather than emotionally. They can evaluate opportunities before urgency dominates headlines. They can position themselves before consensus forms. The individuals who wait for certainty often discover that certainty arrives after the largest moves have already occurred. That lesson appears repeatedly throughout financial history. By the time everyone agrees on a trend, the easy opportunity is usually gone. That does not mean investors should panic. It does not mean they should chase every rally. It means they should pay attention. They should understand that today's environment contains pressures that did not exist to the same degree a decade ago. They should recognize that debt, inflation, currency concerns, geopolitical fragmentation, and monetary uncertainty are interacting simultaneously, and they should appreciate that precious metals frequently respond to those conditions long before broader markets fully acknowledge them. The real question is not whether volatility will occur. Volatility is inevitable. The real question is whether investors are prepared for the possibility that the next phase of the financial cycle may look very different from the one they have become accustomed to. Because if that transition is beginning, gold and silver may be sending signals that many people still fail to recognize. Now, I want you to step back even further because the biggest developments are often missed when investors focus too narrowly on daily market activity. The movement in gold and silver is important, but it becomes much more meaningful when viewed through the lens of long-term financial cycles. History is filled with examples of systems reaching points where existing assumptions could no longer be maintained. The details changed from era to era, but the underlying pattern remained remarkably consistent. Debt accumulated, obligations expanded, policymakers attempted to balance competing priorities, economic pressures intensified. Eventually, markets were forced to reprice risk, reassess value, and adjust to a new reality. That process is rarely comfortable, it rarely happens in a straight line, and it almost never unfolds according to popular expectations. The reason I emphasize this is because many investors continue treating today's challenges as temporary disruptions rather than structural developments. They assume inflation will fully normalize. They assume debt burdens will become easier to manage. They assume growth will accelerate enough to solve underlying problems. Perhaps some of those outcomes occur, but prudent investors do not build their entire strategy around optimistic assumptions. They prepare for multiple possibilities. Preparation is not pessimism. Preparation is responsibility. When I look at the current environment, I see a world where governments face increasing financial commitments, where central banks face difficult policy decisions, and where investors are becoming more sensitive to risks that were previously ignored. That combination matters because markets can tolerate individual challenges. What becomes difficult is when several challenges begin reinforcing one another at the same time. Inflation affects interest rates. Interest rates affect debt servicing costs. Debt servicing costs affect government budgets. Government budgets affect fiscal policy. Fiscal policy influences currency confidence. Currency confidence influences capital allocation. Everything connects. And when those connections begin generating pressure throughout the system, investors naturally start searching for assets that can provide resilience. This is where the conversation returns to gold and silver. Their importance is not based solely on price appreciation. Their importance comes from their role during periods of transition. Throughout history, hard assets have often attracted attention when confidence in traditional financial structures becomes less certain, not because investors abandon the system entirely, but because they recognize the value of diversification. That distinction is important. This is not about predicting catastrophe. It is about recognizing changing probabilities. The world does not need a dramatic collapse for precious metals to benefit. It only requires enough uncertainty to encourage capital rotation, and capital rotation is already one of the most important themes developing across global markets. Investors are increasingly evaluating where risk exists and where protection exists. They are questioning assumptions that went largely unchallenged for years. They are considering whether portfolios built for one environment remain appropriate for another. Those questions are healthy. In fact, they are necessary. The danger appears when investors refuse to ask them. The danger appears when people assume the future must resemble the recent past simply because that is what feels comfortable. The financial history offers countless examples of why that approach fails. Markets evolve, conditions change, regimes shift, and when they do, the assets that seemed unimportant can suddenly become highly relevant. Silver has experienced that phenomenon before. For long periods, it attracts limited attention, interest remains low, expectations remain subdued, participation remains modest. Then conditions change, demand increases, supply struggles to respond, capital begins flowing into the sector, and the market reacts much more aggressively than most participants anticipate. That possibility deserves attention today because several supportive forces appear to be aligning simultaneously. Monetary uncertainty remains elevated, difficult challenges continue expanding, industrial demand remains significant, supply growth remains constrained, investor positioning remains relatively light. None of those factors guarantee a specific outcome, but together they create an environment that investors should not ignore. This is why I continue emphasizing awareness over prediction. Predictions create false confidence. Awareness creates flexibility. You do not need to know the exact price target. You do not need to know the precise timing. You only need to recognize that important conditions are developing and that those conditions may have consequences far larger than most people currently expect. That awareness allows you to evaluate opportunities objectively rather than emotionally. It allows you to prepare rather than react. It allows you to make decisions based on structure instead of headlines, because headlines always arrive late. By the time major financial publications explain why a move happened, the move is already underway. By the time consensus forms, positioning has already changed. By the time certainty appears, much of the opportunity has already passed. That is the lesson investors repeatedly learn during every major transition. The people who pay attention to structural developments gain time. The people who wait for universal agreement lose it. As we move forward, the most important question is not whether gold and silver experience short-term fluctuations. They will. The most important question is whether the forces building beneath the surface continue strengthening. If debt pressures remain elevated, if inflation proves persistent, if currency concerns continue growing, and if investors increasingly seek tangible stores of value, then the environment supporting precious metals may become considerably stronger than many currently realize. That possibility should not be dismissed because major opportunities rarely look obvious in their early stages. They look uncertain, they look controversial, they look easy to ignore until suddenly they are impossible to ignore. And if the signals developing today continue expanding into a broader financial transition, those who prepared early may discover that the most valuable asset was not certainty, it was awareness.